Good afternoon, everyone. My name is Alana. That is Eric. Not sure which way I'm pointing. Welcome. It is our Wednesday webinar series. And today we are going to focus on real estate. Today is September 1st. Happy September, everyone. Let us know over here. Can you hear us? Can you see us? We'll give you guys a second. So today is actually a two-part series. So today we'll go over the first part, and then in 2 weeks from today, we'll be doing our second part all about real estate. So very, very exciting. Oh, everyone seems to be hearing us. Great. Welcome, everyone. So nice to have you. So we are going to go through our slides. And then after the slides, we'll address any questions that you guys have. So if you have any questions at all, put them down here, wherever down here is, where it says ask a question, and we will address as many as possible. So Eric, let's jump in.
Let's do it. Hey, everybody. Hey, Ken. Hey, Hannah. Hey, Suzanne. Lots of people piling in. Barbara, Tony, Eric. Let's see. Evander. Good to see everybody in here. That's awesome. Awesome. So we're going to dive into the topic of investing your retirement funds in real estate. Pretty exciting topic. If you guys haven't explored this before, just a quick disclaimer, guys. This is not investment advice. This is not tax advice. This is not legal advice. We always have to kind of set that precursor. This is just education. Just to make sure that if you are needing that kind of advice, that you seek out a professional. So here we are. We're going to talk about investing your retirement funds in real estate. Super exciting. So real estate, obviously you guys probably are familiar. It's been a super popular investment all the way since the 1980s. Self-directed investors have been putting their funds, retirement funds, directly in real estate. It's a great asset class to own. It is a tangible asset. So that means that it's not something like that's paper-based. It's actually physical, right? It also produces yield. It's an appreciating asset, and it's super good at protecting against inflation, which for a lot of people is a growing concern because of all the money printing that's happening right now with our government. So, and we're also going to talk real briefly just about what does it look like to hold real estate inside of your solo 401k or retirement plan, right? What actually makes this possible? What does it entail? How can you do it? We're going to talk about a couple different deal structures, and then also what to watch out for. We have to make sure we're talking about prohibited transactions and active versus passive investments. So we'll get into all of that as well as your guys' question and answers at the end. So big question, right? Do I need a custodian when I have a retirement account, right? So I think this is super important. Obviously, if you guys are new to this self-directed world, most people, when they think of their retirement plan, they think of that big institution or that big brokerage platform, right? Like Schwab, Morgan Stanley, TD Ameritrade, Fidelity. We're pretty much trained to think about, when we think about retirement accounts, we think about these custodians, right? But actually there's a unique distinction, right? When you use Neighbors Group as your document provider for your solo 401k documents, you actually become your own custodian, right? So you actually get to choose where you put your funds, what you invest them in. You're in control, which is super cool. You can invest in things like we're going to discuss today, like real estate, like hard assets. And it's super important that we make that distinction. So kind of break that association in your mind. We're going to talk about what that means, right? Self-custody, checkbook control, putting you in control of your retirement funds so you can invest in what you want to. And then again, we're going to go over plenty of time for Q&As at the end. Also, if you have any specific questions, shoot them over to our team, or especially in our network. We'll post a link to the social network, our private social network. You can network with folks that are clients, fellow investors, ask questions in there, deal structures, anything that you guys need. Our team's there to respond as well. And also set up a free consultation if you need. So just a little diagram to kind of give you guys a visual. Sometimes these concepts are more easily understood with a visual. So with this concept of self-custody, we've got your solo 401k plan documents. That's what's provided by us at Neighbors Group. And then we have the custodian. In this case, you actually are your own custodian, right? So that's what gives you the ability to have self-custody, the ability to have checkbook control to invest in whatever you want to. So let's talk just briefly about what it looks like to set up and invest in real estate. Obviously, you're going to want to reach out to us to establish your account. Our team will help you step by step to set up your plan documents. We'll also help you with funding your account. You can fund your account in two different ways, either from rollovers from previous retirement accounts or from new contributions from your business earnings. Then obviously you're going to want to choose your deals. We'll go over a couple different deal structures. In our second part of our webinar, we'll go over more different types of deal structures, pick your assets, and then go ahead and invest, right? Send the funds directly to the closing table. You have full checkbook control. You don't need to ask anybody's permission. You don't need to ask us permission. Just do the investments that you want to.
Oh, bear with me.
So we'll just, we know everybody likes a nice little visual. So these are the two ways to fund your solo 401k is through number one, the rollovers. So take any other previous IRA accounts that are floating out there or previous employer 401k accounts, other solo 401k accounts, basically anything that's a pre-tax account, whether it's a 457, 403b, pension funds, virtually anything, most anything can roll into the solo 401k. The only one that cannot is the Roth IRA. We do have a different type of structure for that. If you are wanting to use a Roth IRA to invest in real estate, we can also set that up for you here at Neighbors Group. Also for the solo 401k, you can contribute money directly from your business's earnings, right? We have a handy contribution calculator that you can use on our website, as well as talking to your tax professional. But monies that you earn in your business can be added to your solo 401k so that you can do more deals. So let's go over a quick example. We're obviously going to get more details about this. It's really pretty simple, right? Once your account, your checking account, your trust checking account is funded with monies from either a rollover or a new contribution, then you can send either a wire or a check, cashier's check, directly from your trust checking account to the closing table. And then obviously you take title to that real estate, that contract goes over, and your solo 401k then owns that property. So we're going to touch on just a couple of basics here, types of deals, right? We're going to talk about purchasing a property direct with cash. Also, we're going to talk about purchasing a property inside of your solo 401k or self-directed IRA with financing. Also, we're going to talk about if you wanted to do deals outside of that account, utilizing a participant loan, which is a feature that your solo 401k comes with.
Wonderful. Thank you, Eric. So let's talk about buying property direct with cash. So this means you're not going to use any leverage, no financing, there's no mortgage. Let's take a look at an example. We have David. He lives in Columbus, Ohio, and he has about $450,000 in his solo 401k. He's done his research. He sees that the rental market is strong and it is growing, just like everywhere right now. So David, he identifies a property he wants, and the property is $120,000, which seems to be a great fit. You know, he has $450 in his solo 401k. The property is $120. You know, that leaves him with plenty of money. You know, when searching for your property, you do have to keep this in mind, because let's say David found a property that was $400,000. He may not want to spend that much on the property because it only leaves him with $50,000 in his solo 401k. Because what's really important is that everything is going to come out of your 401k. For instance, property taxes. If something breaks, what if you need a new roof? What if there's a catastrophe? You want to make sure that you have enough funds in your 401k. So property selection is really important, and that includes the pricing. So here's a little breakdown, how much the property is going to bring in for rental income. And then, he took a look at all the expenses, because you want to make sure, does this make sense to do this with my solo 401k? Here's a breakdown of, what the monthly cash flow is going to be. So he crunched all of his numbers and he found out that the cash flow is going to be $712 a month. That's a great deal. So he decides to proceed. So his solo 401k is called Jones Investment Trusts. He is the trustee, so he gets to sign for everything. But what's really important is that everything's coming from his solo 401k trust checking account. So David sends the earnest money from there to the escrow company. And we'll reiterate, everything is going to be in the name of Jones Investment Trust. So the property and purchase agreement, Jones Investment Trust, everything is titled in that name. So David signs for everything because he's the trustee, and he just simply wires the rest of the funds from his trust checking account to the deal. Rent checks are coming in and they're going back into his trust checking account. Property taxes are due, it's coming out of the trust checking account. Expenses, repairs, anything that is needed for this property, it's coming out of his solo 401k bank account. That's why, we stress the importance of choosing the right property, because you will have to pay for other things. You can't just buy the property and then there's nothing else to pay for. So being aware of all of this is very, very important. If David decides to sell the property, of course, the seller is going to be his trust name, Jones Investment Trusts. The title company will send the proceeds just right back to the trust checking account. So you guys see it flows, everything flows in and out of that trust checking account. What's great about this, there's no 1031 exchange needed. He's able to sell the property, put the profits back into his 401k, and move on to the next deal. We all like that visual. So like you see, the funds go from his trust checking account to the closing table. He owns this property. It's much easier than you would, think. Purchasing real estate in your solo 401k is so doable. One more look at his cash deal stats. And, just to speak about it, crunching your numbers, knowing the income, knowing the expenses. This is all a part of your due diligence. Make sure the deal is right for you and for your 401k.
Perfect. Thanks, Alana. Yeah. So let's talk about another option is using financing, right? So you can purchase a property with all cash, but inside of your solo 401k, you can also use a type of financing to find and purchase a deal. So what does that mean? Financing, right? It just means just like you would outside, you're going to get a mortgage, right? Typically that mortgage will come from a private bank, a lender, a private party maybe. But just remember the main thing to keep in mind here, that the loan needs to be a non-recourse loan. I'll cover a little bit more about what that means. There's a couple special considerations for that non-recourse loan. Let's just jump in here and we'll go over an example deal. That'll make it crystal clear. So let's talk about Claire. She lives in California. Obviously, property values are very high in California. For those of you guys that live there, I live there as well. Median property values are like $800,000. So she's looking in a different state. In this case, it's Texas. Claire finds that actually she currently has $200,000 in her retirement account, her solo 401k, which she has named Joyful Retirement Trust. She's identified a property in Dallas that's worth it's cost $150,000. She doesn't, just like Alana said, because she doesn't want to use a majority of her funds in there, she decides that she's going to look for financing for a portion of the deal. So same thing, she crunches her numbers. She sees the purchase price is $150,000. She can put a down payment on it. She can get the rest with a loan. She has to consider the interest rate, the term, what's the monthly mortgage payment going to be? Is that deal still going to cash flow? She runs her numbers and looks at the expenses. Obviously, again, this is all the due diligence. This is what you're doing when you're finding your deal. You're looking for the right deal to work well with what you have to work with. So she finds that she's going to get a great deal on this property. It's going to be a similar deal to what the previous example had. She's going to have plenty of cash flow still coming in, even after the mortgage payment. She'll have some money left in her solo 401k to cover any unexpected expenses. That way, she doesn't have to worry. She's making sure that she's done all of her due diligence. She's looking like she'll have an appreciation on the property as well. So things are looking good with this deal. So one big note is that what non-recourse means, right, is that we want to make sure that we're not adding our own personal guarantee onto that mortgage, right? We want to make sure that it's non-recourse. What that means is that the loan requirements are a little bit different for your retirement account to get a mortgage, right? So let's go over what those requirements are. So like I said, there's no personal guarantee. You don't want to add, so essentially by personally guaranteeing it, you're adding your personal value into your retirement account. That's what we'll talk about more. That's a prohibited transaction. But the good news is that there's no credit checks, no income statements, because this is secured by the actual property itself. Typically, you do have to put down a little bit more. We're talking about maybe 40 to 50% down, as opposed to conventional financing is closer to 20. Because there is a little bit higher risk for the lender, right? They don't have you to come after if something were to go wrong. And that's really what that means, right? The recourse for the lender in this case is really just to foreclose on the property, since that's the only collateral that they really have. They don't have your personal assets to go after, which is actually good for you, right? So in this case, Claire, she signs a non-recourse loan with a bank. The 401k trust receives the mortgage. At closing, Claire just sends her down payment from the trust checking account directly to the title company. She signs the purchase agreement as the trustee of her solo 401k trust. And then that purchase agreement for the property is obviously, like we've talked about, it's in the name of her trust. She's not taking on that property personally. And then the bank, once that transaction closes, they wire the rest of the funds to the closing table, and she takes ownership of that property in her trust. Again, looks like a great deal. She's got great cash flow. She's got great appreciation. Net of the mortgage, she's still making a great return. Perfectly good deal. So one thing, guys, too, on non-recourse loans, we have a list of great lenders in our knowledge base, solo401k.com. On the knowledge base, you can search for different articles, additional videos, walkthroughs about this. If you need lender resources, we have a few recommended banks to look into. Obviously, do your due diligence. We also have past webinars that we've done on non-recourse loans if you want to dig into this deeper. Obviously, we don't have enough time to cover in detail every single aspect, but do your due diligence, and we have tons of ways to support you.
Yeah, if you guys want to learn more about the non-recourse loan, definitely check out the webinar that's in the network. Just type in non-recourse. It's a great webinar with Solera Bank. They get all the details to you about, non-recourse loans, how it works, what they look at. So if you're interested, check out that webinar. It's superb. Let's talk about rental property best practices, because rental properties, it's a huge solo 401k investment, very popular because it's very passive, and that's what you're looking for. So How should you handle your rental properties? Hiring a third-party manager, property manager, is highly, highly recommended. You can be the property manager, but you have to be very careful and follow the rules. You are not to pay yourself or receive any compensation for managing the property. You are managing the property. You are not the landlord. If something breaks, if you need work done on your rental property, you must hire out. I know you may think, I could fix this sink. I've done it before in my house. You do not want to do that. That is a big no-no. I know you don't want to spend $100, $200 getting it fixed, but you have to do it the right way. We don't want to mess with the IRS for a simple, repair that maybe only cost you $200. The consequences for doing a prohibited transaction are way steep than just hiring out for these repairs, maintenance. Also, you do not want to hire your family members. We'll go into details about disqualified people, but them too, they are not allowed to work on the house as well. So it would not be fair if your husband is a general contractor or your daughter is a real estate agent. Also, you may not be the realtor when your solo 401k buys or sells a property. In other words, always maintain arm's length from your solo 401k investments. I'm sure you have heard us say that before. If your funds are in a deal, you personally are not. So let's talk about the participant loan. So it's important to know that if you're going to utilize the participant loan, it's no longer an investment within your solo 401k. So this is great for certain things that would be typically disqualified. So remember, if you're taking the loan, it's no longer an investment. It's you borrowing funds from your solo 401k. The participant loan can be used for anything. So we're going to focus on why it could be good for real estate. So you can use the participant loan for a primary residence. A lot of people like to utilize this. Also, let's say you do want to buy a property in your own personal name or maybe in your business name. You can take this loan out and help fund that property from there. There are some advantages for doing it this way. So it's a lower down payment. What if you have higher loan terms on something? If you buy a property using a participant loan, you can do things like work on it. Everything that I just talked about before, you can do these kind of things if you're just going to take out the participant loan and purchase a property in your personal name. Also, fix and flips. The buy, rehab, rent, refinance, repeat. That participant loan might be great for something like that. If you haven't seen this in your dashboard, there is a participant loan generator. We have made this very, very, very easy on you. You'll just click loan and you'll input your information. You'll have all your paperwork in less than 60 seconds. And since you're the one that has, full checkbook control, once you generate the documents, all you do is sign it, and then you're going to write yourself a check from your trust checking account or your brokerage account to you personally. Once those funds are in your personal account, you can do whatever you want with it. You can never take the participant loan and give yourself a check like maybe to your business. It's got to go in the right flow. So it's always going from your trust checking account to you personally, and then from there, wherever you want it to go. Same with when you're paying it back. Wherever those funds were, they need to first go back to you personally, and then from your personal account back to that trust checking account. We include everything in that paperwork, your repayment schedule. You could also calculate your loan. You'll see we have a fun little calculator as well. So use the tools we have given you. We've done this for you guys. So once you cash your loan check, you're ready to invest. So, and like I said, what's really important is, you do have to pay back that loan. We do give you the schedule for your monthly fees. You can pay it back quarterly, but just don't miss a payment. You don't want anything to be counted as a distribution. And of course, you're never going to use your business funds to pay back the loan. It's always going to go, remember, from your personal account back to your trust checking account. Let's look at Ben's example. So Ben wants to use the participant loan to fund a primary residence. He can pay the solo 401k back over a 15-year period. So typically that participant loan is going to be for 5 years. But if it's for your primary residency and only your primary, you can actually extend it to 15 years. Ben has $250,000 in Eternal Youth Trust. That is his solo 401k. So he decides he wants to take the $50,000 loan as opposed to going to a bank and getting a high interest loan and having to give them all the interest payments. With the participant loan, your solo 401k gets all those interest payments. So it's a great idea for Ben. Let's look at Ginny. So Ginny found a great fix and flip. The price for the house is $100,000. Ginny has $100,000 in personal funds, but she needs another $50,000 to pay for the rehab. Ginny doesn't want to take a loan from a bank. And since she has $100,000 in her solo 401k, she can take the full $50,000. So with the participant loan, you can take 50% or $50,000, whichever is less. So she meets that requirement. So she takes the loan, purchases the property. Ginny rehabbed the property and she sold it for $250,000. She made $100,000 from the deal and she doesn't have to worry about paying a bank back plus the interest. She's paying her solo 401k. And what's an additional bonus? She's getting an extra $5,588.67 back into her solo 401k. So some great components to this participant loan.
Thanks, Alana. That was amazing. So looks like, yeah, we're on to the next section, which is avoiding costly mistakes. We've been talking about making additional high returns based on these different deal structures, even utilizing that participant loan. But we also want to avoid, on the other side, losing out on those high returns, right? If we make those costly mistakes, we don't want that to happen. So let's go over prohibited transactions. When you are taking custody of your funds, you just want to make sure that you're staying in compliance with all the IRS's rules. As long as we're working within the rules, we can do all of these things that we've been talking about. So we're going to basically talk about with any retirement account, whether it's a 401k or an IRA, who is a prohibited, what defines a prohibited transaction? So there's a couple of things to consider. There's one, prohibited assets. For the most part, you can invest in whatever you want to, whether it's real estate, precious metals, cryptocurrencies is super popular, obviously, private notes, mortgage notes, tax liens, virtually anything you can think of. The only thing that typically isn't allowed is collectibles, which includes wine, artwork, rugs, collectible coins. Just make sure that if you're not sure, check with somebody in our network. You can leave a message in the network. You can contact us if you have a question. And obviously, if you have a great tax advisor, they can help you as well. But what's good news is that real estate is not a prohibited asset. There's no such thing as a collectible piece of real estate. All real property is able to be purchased inside of your solo 401k. Then we also have to talk about prohibited people, right? Prohibited people are what's called disqualified persons. Those are people that are prohibited from transacting with your retirement trust, your solo 401k retirement trust. You do not want to sell or buy assets from these people or entities, okay? So what constitutes a disqualified person? Well, that would be you personally, right? If you're thinking about doing things personally in terms of a transaction, maybe think about that participant loan like Alana had talked about, right? If you're doing things inside of your retirement account, you just want to maintain that arm's length. So that's you, your spouse, as far as the IRS is concerned, your spouse and you are virtually the same person. So any transactions between you and them, that is the same person. Also, any fiduciaries for the plan or anybody who provides services to that plan. So for you, since you're the trustee, same thing. Also, any lineal ascendants or lineal descendants. So that would be like your parents, your grandparents, your kids, your grandkids, and even spouses of those kids, right? So even your son-in-law or your daughter-in-law would be a prohibited transaction. What is funny is your mother-in-law is not. So if you're unsure if somebody's a disqualified person, just reach out to the network, shoot a message in there. Our team's there available. Also, the community's there. There's a lot of experienced self-directed investors that'd be happy to weigh in. And if you're totally want a completely good advice, probably talk to a qualified attorney or CPA about it. So think about this, right? So if you were to say, for example, you owned a piece of property and you decided to sell that property directly to your retirement trust, essentially you're giving yourself money, right? You're giving yourself value. Value's moving from inside your retirement to outside. In a certain way, that looks like a distribution to the IRS. So you just want to be careful with that. You definitely don't want to, mix your personal stuff with your retirement stuff. As long as you're keeping those things separate, you're going to have no issues whatsoever. Also, one thing we'll talk about a little bit more is that you don't want to add value to that property by working on it yourself personally. By doing that, maybe making an improvement, you might be improving the value on that property, which that sounds like a good thing, right? But because it's inside of your retirement account, you're actually giving yourself kind of a hidden tax benefit. So you want to make sure that if you are performing work, that you're having a third party do it. Nobody in your, none of your kids, none of your grandparents, none of your parents doing it. Make sure that it's somebody that's arm's length. So again, it's important that those deals that are done inside your retirement account are separate from you doing them personally. A good rule of thumb is if your retirement account is in the deal, you aren't, right? So if you're like in those examples where you're purchasing a property with cash or with financing, just keep your personal funds out of the deal. Simple and easy. If you're doing any repairs or maintenance on the property, just hire a third party, right? Hire a handyman, hire a property manager. That way you're not putting any sweat equity into the deal. You're not improving the value with your own personal self. And that way you're not committing a prohibited transaction. Perfect. So let's go over an example for a couple prohibited transactions. You own a construction firm. That firm basically is prohibited from working on your solo 401k owned properties, right? Or let's say, example, your dad is a realtor. Maybe you want to use him to buy or to sell a property inside of your solo 401k. Again, same thing. That would be a prohibited transaction because, somebody in your ascendants or lineal descendants is benefiting from that transaction. Also, your spouse, let's imagine they own a rental property and they want to sell it. You're prohibited from purchasing that property with your solo 401k funds. Let's also think about if you're a plumber, right? That's your occupation. Maybe you might think that's totally cool to do. But in the case with your solo 401k, you just want to keep that separate. So if there's a broken pipe, maybe just hire your associate or someone else, another company. That way you are maintaining that separateness from that transaction.
Awesome. Thank you, Eric. It's so important to talk about prohibited transactions. You may want to make a list of all the people that are considered disqualified. Have that list so you can always refer back to it. So awesome. Let's now talk about passive versus active. So when you're thinking about what you want to purchase with your solo 401k, you are thinking passive. This is mailbox money. You're keeping that arm's length distance. You're not working on these properties, all those things that we were talking about. And passive real estate works really well in your solo 401k. Then there's active real estate. That's if you're doing a lot of the work, and lots of fix and flips. That's active. So you may want to think about keeping that outside your retirement account. So keep active income in your business, passive income in your retirement account. These are some examples. So for passive income, rental properties, they're great. And a little teaser, guys, the next few items we'll be going over in 2 weeks. Real estate funds such as syndications, REITs, and crowdfunding, mortgage notes, and farmlands. So these are great options, especially if you don't have enough funds for like a all cash property, or even like getting a non-recourse loan and purchasing a property. There are so many other ways to have real estate in your solo 401k. So we're very excited for the second part of this series. So active income, fix and flips. I know we've said that you could possibly do one or two, but that's definitely really important. Fix and flips are typically active income. Ooh. Sorry, my Siri is going off. That is so weird.
Funny.
Technology is scary sometimes. Okay, sorry about that, guys. And my phone is across the room. So anyway, then we also have Airbnbs, that too, where that's more of a business. So keep that as your business. And then, of course, commissions from real estate deals and property management. This is all active income. So a quick little recap of prohibited transactions. Never buy or sell real estate to or from a disqualified person. You're not doing any of the work on this property as well, and you're not paying yourself commissions as a real estate agent for these IRA or 401k properties. I know we've done lots of recaps, but this is really, really important. So we are just driving it in there. It's okay to manage these properties, but just follow the rules. You're not compensating yourself. You're also not doing any of the blue collar work. So no rehab, no fixing it up. You're not even going to change the light bulbs. So you're only doing the ministerial duties. So you're collecting rent checks, you're screening tenants, and you're hiring those third parties, even if it's just to change that light bulb. You're never going to live in that property either. That is a big one. I know it's hard to think that you can't live in a property that you own, but your solo 401k or your self-directed IRA owns that property, so you're not living in it. And like we've said, with the fix and flips, it is a gray area. What we've heard is that 1 to 2 per year is okay. Of course, you want to consult your legal team, your CPAs.
Awesome. So this has been super great, guys. Just to recap what we talked about today, we talked about the advantages of taking self-custody of your funds, right? Where we broke, hopefully for you, started to break that association with, those big institutions. Now you can actually self-direct your investments. You have custody over them. You can pick real estate as an investment class to invest in. Hopefully you've seen how relatively simple that is to do. We talked about different deals. We talked about the full cash deal. We talked about the financed property deal. There's a ton of different ways. We're going to talk about more different ways in this 2-part series. Just a teaser, that's going to be next week, or in 2 weeks. We're going to go over additional ways to invest in real estate if you don't have maybe a couple $100,000 to invest directly in real estate. We'll talk about syndications, REITs, crowdfunding, promissory notes, farmland, lots of cool ways to invest in real estate, even if you have only a little bit of funds in your real estate or in your solo 401k account. So we look forward to having you guys on that training. It's going to be super awesome.
Perfect.
Now we're going to open it up, guys, for Q&A. We have about 20 more minutes here till the top of the hour. Looks like we've had some questions already come in. I see some questions here on the side as well as in the question box. So let's dive in and start answering some of these questions. So I've got the first one. here came in from Ken. He says, my question is about income taxes. The trust may have to pay a 35% related to various real estate deals. 1, interest earned on loans / mortgages. 2, buy property cash, sell at a profit or buy cash, sell at less taxes. 3, shares in private placement offerings set up as LLC, where a general manager does everything. 1, owns, rents vacation homes and sends net proceeds to the LLC members. Another is a developer who sells lots to builders, distributing the gains to the LLC members. Great question, Ken.
There's a lot going on here. So let's break down and see what we can answer here. So, there's everything's tax deferred. You're not paying any taxes. But so something also to be aware of is that you're also not taking any depreciation. So if there is a loss with your property, you don't get that depreciation. So, when we talk about property selection, should this property be in my solo 401k? Should it be in my personal funds? That's something to, look into. If there's going to be a lot of depreciation, maybe you don't want to put it in your solo 401k. So you want something that's not going to have a lot of depreciation. That's just passive, those easy rent checks, that mailbox money. Let's see. And then shares in a private placement offering set up as an LLC, where a general manager does everything. One owns, rents vacation homes and sends the net proceeds to the LLC members. That seems okay. That does not seem like a problem. Another, a developer
seems similar to like what we'll talk about in 2 weeks, like a syndication, where you're the limited partner and there's a general partner on the deal. You're passively invested, so I don't see any issue with that.
Yeah. Anything else you want to add?
I think the main thing that he's getting at just is he's asking, it looks like, if he buys the property with cash and sells it at a profit, or buys for cash and sells it at a loss, is there any taxes due? There is not. So because it's inside of your solo 401k, if you have a profit on that deal, you don't pay any capital gains taxes. It's all tax deferred. Also, you don't have to worry about 1031 exchanges like we talked about. That money can just go into another deal. It actually doesn't even have to go back into real estate, right? You could reinvest that money into another asset class. So super powerful because you can switch between asset classes. And interest earned on loans or mortgages, same thing, because it's inside of the solo 401k. It's all tax deferred, whether it's in your traditional funds or whether it's in your Roth bucket. With our solo 401k plan, it comes with both the traditional bucket and the Roth bucket. So you can invest funds from either one, but either way, they're tax deferred until you decide to distribute those funds at retirement.
Perfect. Great. Thank you, Eric.
It looks like he put in a question around
UBIT. Yeah. And I think Rachel answered that question for Ken. We do have Rachel here jumping in, helping us out here.
I love it. Looks like the next question came from Ken. What's the current participant loan interest rate? And again, looks like Rachel jumped in the comments there. Right now, it's the prime rate, which is 3.25% plus 1, which makes it 4.25%.
Perfect. Great. Thank you, Ken. Thank you, Eric. Thank you, Rachel.
Next question from Adam is that $50,000 per person for a participant loan if your spouse is also part of your solo 401k plan? That's a great question, Adam.
It is, Adam. So actually, you guys each get up to 50% or $50,000. So potentially you could take $100,000. So excellent question. So it's per person. Then the next question comes from Barbara. I'm interested in using my 401k funds in a real estate syndication. The offering has both Class A and Class B, C options. Class A is for cash flow. Cash B offers depreciation to offset taxes. How does the depreciation help with taxes when inside a retirement account?
That's a great question. Alana, you wanna...
Yeah. So, Barbara, I do not think that you can take depreciation. With retirement accounts, there is no depreciation. So you probably don't want to go for that Class B. Maybe that Class A would probably be a better option. So definitely consult with your CPA. But yes, a great question. But the moral of the story is there is no depreciation within any of your assets for the solo 401k.
Perfect. It looks like, oh, we got a question about are NFTs from Adam, are NFTs prohibited transactions? So I think what he's talking about is non-fungible tokens. So that's not technically real estate, but happy to answer that question as well. They actually have been determined to be collectibles, Adam. So they are prohibited. So yeah, great question. Definitely, if you're unsure, also ask it in the network, like I had talked about earlier. But yeah, non-fungible tokens are collectibles.
Wonderful. The next question comes from Ken. What about my customer who needed a loan to stay afloat? Do you want me to tackle that one, Eric?
Sure, yeah.
So, Ken, not 100% sure what you're asking. So, what about my customer who needs a loan to stay afloat? So, if your customer is not related to you in any way, I mean, you could give them a loan. That's not considered a prohibited transaction. Of course, if you're doing some kind of loan, promissory note, you want to work with your legal counsel to make sure it's done correctly, but it does not seem like a problem. Another question from Ken. What about keeping the books for the solo 401k?
Yeah. So yeah, you since you are the trustee of your plan, you're the plan administrator. Yeah, you want to keep good, detailed, accurate books, right? Some of our clients choose to hire a bookkeeper to do that. Some of them just keep track on an Excel spreadsheet. Either way, you want to keep good, detailed records. So that when we were talking about those different deal structures, you want to crunch the numbers. You want to keep track of what that original purchase price was. Yeah, you want to definitely keep good, accurate records.
Yeah, absolutely. And, all of us here are business owners, so your time is so valuable. So hiring a bookkeeper that may not even cost that much money may save you money. So something to think about. Do you want a bookkeeper? A lot of people do that. And a lot of people keep their own records too. So it's really up to you. What is your threshold? What can you handle? So great question, Ken.
Perfect. And I got a question here from Tom. He says, can I invest in Airbnb and have property manager just invest? Can I include in my trust? I am a passive investor is what he says.
Yeah, with an Airbnb, there is ways to go about it. I've heard of forming like a C Corp and having shares, and then you could invest your trust in those shares. There are ways, and what you're talking about too may be possible as well, Tom. So Airbnbs are definitely not like an absolute no, but it is about how you do it. So great question. Definitely something to double check with your CPA because you want to make sure that it's continuing to stay passive. So I think that this is possible, but definitely double check. Okay, the next question comes from Todd. Please confirm that a participant loan is maxed out at 50% of the solo 401k balance and not to exceed $50,000.
Yeah, great question, Todd. It is. Yeah, so it's the lesser of 50% of the total value of your account or 50,000. So if you have 100,000, you can obviously do the full 50. If you're under 100, you just basically take whatever amount you have and divide that by 2. And that's how much you can take as a loan.
Great.
Next question comes from Hector. Does the property need to be in the name of the 401k plan, trust fund, or special purpose LLC?
Excellent question, Hector. So It depends. I'll tell you this, it's definitely not in the name of the plan. So that your plan name is just your documents. Remember, when investing, you're always going to use your trust name, and maybe you have a special purpose LLC. So if you do have a special purpose LLC, especially one that we set up for you, that your trust is the member and you are the manager, great. You could absolutely purchase properties in the name of your special purpose LLC. So it depends. If you want to use your LLC, yeah, then you are going to make sure that the name on the title is the name of your LLC, and make sure that the funds are coming from your LLC bank account to the closing table. If you're going to use your trust name, make sure the funds are coming from your trust checking account and they're going to the closing table, and then the name on that title is going to be your trust name. So great question, Hector. It could be either your trust name or your special purpose LLC. The next question comes from Charles. How does minimum distribution work with real estate in a 401k? Do I have to liquidate the property?
Great question. So really, this would probably depend on what your deal structure was, right, Charles? So everybody's deal structure might be different. Also keep in mind that those required minimum distributions are calculated across all of your retirement accounts, right? So if you do have other IRAs floating out there or other 401ks out there, you want to calculate those. You want to work with your tax professional for sure, because you may be able to take monies from one account to cover your full required minimum distribution, right? But that's definitely something to keep in mind is liquidity within your retirement account. You want to make sure that, like we were talking about with that cash deal, that you're not leaving yourself with no extra cash in your retirement account. So these are kind of more like best practices, right? Because in the event that you do need to take those RMDs, if that was your only account, yeah, that may mean you may need to liquidate that property, right? If you have an unexpected expense, same thing, right? If you have a big repair on the roof or on, say, the water heater breaks, and you have no cash in your account, then you're going to have to potentially do something that maybe isn't in the best interest of your overall value in your account.
Yeah, that's a great question, Charles. And it's really important to work with your CPA when you're getting close to that time where you have to take those distributions. So you guys can start planning for it, strategizing. I think there is also a way that you can take some distributions from that property, but definitely work with your CPA. So awesome question. Thank you, Charles. And thank you, Eric.
Another question came from Jamal. Can my property get paid by an LLC that owns the property?
Can my property get paid by an LLC that owns the property? Is this LLC your special purpose LLC? I'm not quite sure of your question here, Jamal, but what I can tell you, if this LLC is like a business LLC, if this is not a special purpose LLC that's attached to your solo 401k, I'm going to say that this is a pickle. So if you can let us know who exactly owns that LLC, maybe we can dig a little deeper. The next question comes from Tony. Can I do a cash out refi on my primary residence with a participant loan?
Great question, Tony. Yeah. You definitely can use those participant loan proceeds for whatever you want to. Again, like Alana had gone over, that participant loan goes to you personally, right? So you could take that money. So once you generate those documents, that participant loan documents, you can then write yourself personally a check from your trust checking account, and those funds are then yours to use however you want to. We have clients that use those to purchase a mobile home, variety of things, right? You can get creative, right? Those funds, once they're out of the retirement account, and keep in mind that's a tax-free event. You don't have to pay any taxes on those funds. Obviously, keep in mind you do have to pay them back over time. But yeah, get creative with that for sure. Next question comes from Bruce. Can you invest in real estate using crowdstreet.com or another site. I can't pronounce that one.
Yep, and Rachel answered that, so we'll talk more about that, but the answer is yes, and we'll go over that in 2 weeks. All right, Bruce, thank you. So Jamal, can the solo 401k get rent money from an LLC I'm an owner?
Yeah.
Still a little unclear.
Yeah, still a little bit unclear.
Yeah, who owns this LLC? Oh, you're the owner of the LLC. Rent money from the 401k. Is your LLC renting the 401k property? Still a little unsure, but if your LLC is renting, or if your 401k is renting from your LLC, this doesn't sound, it sounds like a prohibited transaction, but if you can be a little more clear, we're just not that sure.
Especially it's prohibited if you're like 100% owner of that LLC, like you personally 100% own that LLC. So if it's not the special purpose LLC that's owned by your solo 401k trust and you actually own that LLC personally, I would say that sounds a lot like a prohibited transaction to me.
Perfect.
Another question from Adam. Can you split the real estate ownership between multiple solo 401k accounts with you and your spouse? Example, wife's Roth 401k and my traditional.
Great question, Adam. Yes, you can. Yeah, it really is. So yeah, absolutely. Just make sure you're keeping good detailed records. Let's say your wife's Roth is going to put 20% of the funds in. You're going to put 80%. The property is $100,000. Make sure that $20,000 is leaving your wife's Roth portion. $80,000 is leaving your traditional bucket. And same if you're getting rent checks back in, 20% of that rent check is going into your wife's trust checking account, 80% into yours. So the answer to that is yes. And you just want to keep very good detailed records. Great question, Adam. We have a question from Suzanne. Is a sister or brother disqualified people?
Yeah, so in this case, no, they would not be disqualified persons, right? So like we went over, that would be yourself, your spouse, and any of your lineal ascendants, which is your parents, grandparents, on and on up, and any of your lineal descendants. So your kids, grandkids, also spouses of those folks. They count as, like I said, the IRS basically considers if you're married that you and them are almost like the same person for tax purposes or for retirement account purposes. So yeah, sister and brother should be totally fine.
Good question, Suzanne.
Also, another question from Jamal. Can my solo 401k own a management company that collects rent from LLCs that own the properties?
Okay, Jamal, that sounds like more of a business. Remember, your solo 401k, all investments should be passive. So double check with your CPA. It's important to know, what's passive, what's active. Keep your investments passive. Thank you, Jamal.
Next question from Tracy. Does a loan/mortgage for real estate purchase within the solo 401k trigger a taxable event, or is it all deferred?
Great question, Tracy. So within your solo 401k, you could absolutely get a loan or a mortgage, and there's no taxable event there. So remember, everything in your solo 401k is tax deferred. The only way you're going to have to pay taxes if you do something like have an active business within your solo 401k. That's why we're avoiding that and keeping everything passive. Good question, Tracy. We have a question from G. Can you take a loan from your life policy and use to contribute to the Roth solo 401k?
Great question. Very creative idea. In this case, there's only two ways to get money into your solo 401k, right? It's from a rollover from a previous retirement account, or it's from a new contribution from your business earnings. So the monies that you contribute are based on what your business has actually earned, right? So you have to make sure that you can't contribute more than your business has earned. That money's has to come from business earnings though. So I don't think that probably borrowing money from your life insurance policy and contributing it to your Roth is probably possible. That's probably not possible.
All right. And the last question comes from Suzanne. We'll make it fast because it's been an hour. Can my solo 401k charge more than 4.25% on the participant loan? Suzanne, it's going to be 4.25%. It stays at that number unless the prime rate changes. So it's always the prime rate plus 1. Thank you, Suzanne. And thank you, everyone, for participating. Thank you, Eric. And thank you, all of our solo 401k clients and possible people that will become clients. We love doing these. We will see you in 2 weeks for part 2. That'll be on September 15th. Of course, join us on Mondays for our Q&As at 6 p.m. Eastern every single Monday. Everyone go have a great week.
Have a great week, guys. Take care.